Good morning, everyone, and thank you for joining us for today's webinar, Understanding the World in 2026. We are pleased to be joined today by Kevin Lings, Chief Economist of STANLIB, Richo Venter, who's Head of Portfolio Management at STANLIB Multi-Manager and in 8Invest, who will share the insights and perspectives on the recent global and local developments shaping the investment landscape. After a strong 2025 for markets, particularly in South Africa and across emerging markets, 2026 began on a constructive note. However, the environment has shifted meaningfully in recent weeks. Renewed geopolitical tensions in the Middle East, ongoing uncertainty around inflation and interest rates, and heightened market volatility have all contributed to a far more unsettled investment backdrop. As a result, investors have seen sharp moves across major asset classes and markets. Equity markets have come under pressure, oil prices have risen significantly, gold has been volatile after reaching record highs earlier this year, and many clients have experienced declines in their portfolios. At the same time, South Africa is heading towards an important political period later this year, with local election outcomes likely to carry meaningful implications for sentiment and confidence. Against this backdrop, an important question is whether we are seeing now is another period of volatility and correction of the kind investors have experienced many times before. Episodes that have historically been followed by recovery and new highs, or whether this cycle may prove more challenging in a world of structurally higher inflation, elevated interest rates, and ongoing geopolitical risk. That is exactly what we will be unpacking today with our guests. What is happening, what may lie ahead, and how investors should think about the world in 2026. We are starting today with Kevin Lings with an economic oversight. So Kevin has been a chief economist for STANLIB Asset Management for the past 24 years and has worked as an economist in the financial services industry for more than 36 years. As STANLIB's chief economist, he is responsible for domestic and global economic research and forecast. Kevin focuses on analyzing key economic developments in South Africa, as well as the major development economies, and then assessing how that is likely to impact financial market performance, as well as asset allocation decisions. Prior to joining STANLIB, Kevin was employed by JP Morgan Chase as a member of their macroeconomic research team. And in the preceding 10 years, he worked as a senior economist within the Netcore Group, concentrating on sectoral research, assisting in non-financial risks associated with local industries, as well as interest rate and currency risk. Kevin has also published a number of journal articles, both domestically and internationally. Kevin, thank you for joining us today amidst these interesting times. We're looking forward to hearing from you and your thoughts and your views on the global and local economies. Kevin, over to you.
Thanks, Corne. Morning, everyone. I hope everyone's keeping well ahead of a big price increase next week. So there's quite a lot going on we need to talk about. Obviously, developments in Iran are top of mind. So we're going to chat about that and the implications for South Africa. The first major implication is the diesel and petrol price increase. And then what that does to inflation, what that might do to interest rates. The Reserve Bank meets on interest rates today. If I go back a month, our expectation was that the Reserve Bank would be cutting interest rates today. The inflation numbers, I'll show you in a little while, the inflation numbers in South Africa have actually been very good. So we were certainly on track for at least one, probably two interest rate cuts this year. That was before the Iran war. But with developments in Iran, the oil price, that's all gone away. The Reserve Bank will keep rates on hold and then warn us, highlight that if this conflict continues on for an extended period, then we may well get interest rate increases. So all of that has changed. At the moment, we're looking at a price shock around the world, but I see in Australia more than 500 fuel stations, petrol stations have run out of fuel. So in some parts of Asia, there are reports of fuel shortages. And obviously, if you go from a price shock into a supply shock, it does change the dynamic for your economy. So that's something we need to be mindful of. At this stage, we're not overly concerned about a supply shock in South Africa. We get most of our oil from Nigeria, the rest of Africa, and I think we've procured a fair bit of supply. But clearly, we can get ourselves into difficulty if this thing carries on for an extended period. So what I'm going to do is I'm going to put up some charts as usual. We're going to focus initially on the US. I just want to give you a sense of how the US is doing and what obviously the oil price and so on will mean for them. And then we'll turn to South Africa. There's good news. It's not all bad news. There is some good news on South Africa, mainly around private-public partnerships developing much better. So we've been talking about, for ages, we've been talking about the need for private-public partnerships, but fortunately, there's now evidence of those being put in place. And I remain very hopeful that we'll see further evidence and we'll see a positive impact of those partnerships. I'll explain that as we get to that. So there are some good pieces of news, if you like, but we're not going to be able to get away from this big petrol price adjustment. So let me just put up the charts. There will be some time at the end, I hope, for some questions. I do tend to speak a little bit, so I need to watch the time. And I don't want to steal Richo's time because he's got important stuff to tell us.
Yes, Kevin, sorry, just on that, I just want to remind the audience that if they've got any questions, they please feel free to post it in the Q&A section, and we will answer those questions for you. Thank you.
Thanks, Corne. Okay, so I'm hoping you can see the charts. Let's start with the US. The US economy is doing okay-ish. Their growth rate is not as good as it has been. Certainly, it has slowed down relative to when Biden was president. Not that he did a fantastic job, but the growth rate is not as strong as it was in the preceding, let's say, 3 or 4 years. And the growth rate this year equally will not be quite as good. It doesn't mean that there's a risk at this stage of a recession. That's not what we're talking about. And we're not talking about any global recession. There's nothing like that that's been discussed. What we are talking about is some slowdown in economic activity because of the Iran crisis, but it tends to cause much more of a concern about inflation than a concern about growth, certainly in the initial stage. Obviously, if the Iran crisis carries on, and now we're into months and years, then it will impact growth more substantially. But at this stage, the bigger concern is, what does this do to the inflation dynamics around the world? So why is the US growth rate not as good as it's been? And it's got a hell of a lot to do with a slowdown in labor market conditions or a softening of labor market conditions. So on the screen, I've just got a chart of how many jobs are added every month in the United States. And in preceding years, ignore 21 because that's a recovery from COVID. But if you look 2023, 24, there were no job losses in any of the months, and they were adding jobs typically at about 120, 150,000 jobs a month. So you can imagine if you've already got a very high level of employment, your unemployment rate is below 4%. So your labor market is already doing exceptionally well. And then on top of that, you add 120, 150,000 jobs, then clearly your economy is going to be incredibly vibrant. And that was what the US was enjoying at the time. Alongside of that, there were other significant benefits, particularly household wealth at an all-time record high, house prices at a record high, stock market doing exceptionally well. There were lots of positives that were accompanying that. But if you look in the last, let's say, the last 14 months, certainly since Trump was elected, the labor market has not been as robust. There have been a couple of months where there's been declines, and even in the months where they've added jobs, the number of jobs being added have not been nearly as robust as previously. So now you're looking at an average of about 10 to 15,000 jobs a month. That's significantly lower than an average of 120,000. So what's caused this weakness in terms of the US labor market? And a lot of it has to do with the Liberation Day tariffs. So you have to go back to April last year when President Trump introduced the tariffs, the extreme tariffs for the US. That shocked the US economy. It created a huge amount of uncertainty. It was obviously designed to it was designed to do the opposite, right? The idea was you would protect US industry through these higher tariffs that would encourage domestic consumers to buy locally produced goods. That was supposed to then boost industrial production or boost manufacturing, and that would then re-energize key parts of the US economy. So the idea with the tariffs was to make the US economy stronger, make America great again. That concept of improving industrial activity and adding a lot more jobs within manufacturing. Unfortunately, that's not what has happened. In fact, quite the opposite has happened. The tariffs have created a huge amount of uncertainty. That uncertainty has led to a wait-and-see approach by many businesses, including manufacturers, and they've become very reluctant to add jobs, very reluctant to invest and expand, because they're just unsure about where the tariffs are going and how long they'll be in place. And so confidence levels have declined. And the net result for US manufacturing employment is that since Trump's been elected, there's been only 1 month in which they've added jobs. So this is US manufacturing, and I've purposely just chosen a short time period from when Trump was elected, and you can see pretty much almost every month they've lost jobs. And in total over that time period, they've lost 120,000 jobs in manufacturing. And that's put the US economy under a bit of pressure. There have been other areas where they've also lost jobs. Doesn't mean every sector's lost jobs. Some areas they've gained, particularly in the healthcare sector. They've added a lot of jobs in healthcare. But the planned impact of the tariffs, that hasn't materialized. Quite the opposite. And so it's put, unfortunately, the US economy under some pressure. As I say, that pressure is not a recession. That pressure is simply lower economic growth. Now, of course, you've got an Iran issue, which is driving up fuel prices, which will put the US economy under more pressure. Again, not a recession, but it does weaken the economic backdrop, if you like. So there have been some other implications of the tariffs I just want to highlight. One is the US now imports quite a lot less from China. So if you look at this is just in value, dollars, billions. How much does the US import from China every month? And in purple, I've just put the time period since Trump was elected. And you can see that pretty much every month is lower than where it was before Trump was elected. So on that basis, you might say, well, the US is importing a lot less from China. This is working. The tariffs are having the desired impact. Unfortunately, what that analysis then misses is that the US is importing from other countries much more than they used to. So let me give an example. And a good example would be Vietnam. So you can see the ramp up in imports from the US, or the US importing from Vietnam, and it corresponds with that exact same time period. So what's going on? What's going on is that goods are being shipped from China to Vietnam. When they get to Vietnam, the label changes, it says made in Vietnam, and then it gets shipped to the US. And so you're doing that in order to try and circumvent the tariff impact. So in a sense, you're not achieving anything here. All you're doing is you add in a cost because the goods have to go through Vietnam to get to the US, and you add in a time delay to the process. And we see similar trends with other countries, not just Vietnam. There's other countries in the region that China would use as a conduit for their trade. So you're still importing Chinese goods, just you're doing it under the disguise of coming from another country. And so I don't think that's necessarily what you actually wanted to achieve. The other impact is that it's costing you a lot more as a US citizen or as a US company because the tariffs are much higher, right? And so the US government is collecting, instead of collecting $8 billion a month, they're collecting 30 billion. And so somebody's got to pay this additional revenue, and that has to be paid by either the company who's importing or by the customer, the consumer, the end user. And what that does is it creates price pressure. It creates an element of inflation within the US economy. And there's no doubt that this has stopped inflation moving down to the target of 2%, and therefore it has stopped further reductions in US interest rates. So I think it's had a negative effect on interest rates. I think it's had a negative effect on inflation. I think it's had a negative effect on the cost of importing and the delay. And I think it's had a negative effect on general economic activity in the US. So I don't see much upside to the tariff initiative. Subsequent to all of this, the US Supreme Court ruled that the tariffs, the liberation tariffs, were illegal. At the time, it was said that they were illegal. Obviously, Trump ignored that and went ahead with the tariffs. But the advice at the time was they're illegal. And then it takes a long time to get this through the court system. So the US Supreme Court ruled it's illegal, and so those tariffs have had to be scrapped. All the Liberation Day tariffs have scrapped. And in its place, Trump put on a tariff of 10% on everything. But he can only keep that in place for 100, I think it's 150 days. And then that tariff will end. And what Trump has said is in the meantime, they'll work out how they can get the tariff back to the level they had previously. So the Trump administration is adamant that they want to have these higher tariffs. My argument is that all of the data that we see suggests it's creating more damage, more harm than good, and I think they would do well to simply get rid of it entirely. Now, on top of that, you've got the oil price, right? So you attack Iran, you blow up parts of Iran. I see in the news that the US is claiming they've hit over 10,000 targets within Iran. So that has inflicted quite a lot of damage, but clearly not enough damage to completely destabilize Iran, and Iran's military remains somewhat effective. They're certainly not as effective as they were, but they have a degree of effectiveness in terms of drones and missiles. And clearly that's put upward pressure on the oil price. The oil price I see today is back up, Brent above $100. And it's pushed up US fuel prices. The gasoline prices moved up, so they have now got an increase that is approaching 25% year on year. Their prices adjust on a daily basis because it's a market-driven price. And it does vary a bit around the country, depending on where you live. There's quite a big difference. But generally, prices have moved up considerably. And obviously, this will now feed into the inflation numbers. And then depending on if the crisis in Iran gets worse, it could well then feed more. So we don't know entirely where this goes from here because you've got to make a guess about the war. You're trying to predict a war. And given that Trump, I think, doesn't know when the war ends, it's very difficult to predict it. We tend to not try and predict it. What we do is we use scenarios. So we say to ourselves, if the war ends quite soon, as in the next couple of weeks, what do we think the implications are? and I'll show you what that looks like for US inflation. But then we have other scenarios, which then says, what happens if the war carries on for 6 months, the war carries on for a couple of years? What do we think that means? So that's how we tend to deal with it. And we look at each scenario and decide, well, which one do we think is the most likely? So in terms of the inflation forecast, this is now, think of it as our base case, as our best guess. Which means that US inflation goes up from here, gets above 3%. Remember, their target is 2%. They never got down to the target. That delayed the interest rate cuts. It's going to go higher. And then, unfortunately, it's going to stay quite a bit above target for some time. And please, this forecast assumes that the war comes to an end within the next few weeks. There's some sort of ceasefire. There's some sort of, okay, we've had enough. That doesn't mean you have to have a full agreement, but that the US at least decides to end their hostilities in that region. And we hope that then Iran follows on the back of that, and the whole area quietens down. It wouldn't be a great outcome in terms of a deal done where all parties are fully on board. I think that's, at this stage, very unlikely. But you can have some sort of easing of hostilities and a pullback of the US military operation. So that's what we've used to put into this. But having said that, we do know that the US has sent about 3,500 Marines to the region. The reports suggest that those Marines start to arrive there tomorrow. And clearly, if you send in 3,500 Marines to the region, you are doing that in preparation for possible a ground operation. In other words, put in military personnel in Iran. On top of that, the US has sent about 3,000 paratroopers from the 82nd Airborne Unit. I think it's the 82nd Parachute Regiment. I'm not sure. It's about one of their battalions. And they have a kind of a force within the 82nd Airborne of about 3,000 that can be deployed within 18 hours anywhere in the world. So think of it as a kind of 3,000 people who are very well trained and very capable, and they keep that as a military force that can be deployed very quickly to any part of the world to deal with any military operation. And that's obviously over and above their special forces. So they've deployed 3,000. And again, that then says that while people keep hoping, like this chart, that the war ends within the next few weeks, if you look at the movement of ground troops, that says, no, that is not a good scenario. And you've got to look at a scenario where the US puts military personnel in Iran. They would have, at this stage, two key objectives. The one objective is to open the Strait of Hormuz by using on-the-ground military activity. Exactly how you do that, I don't know. I think it's not easy, and it may not be achievable, but that would be one of the objectives. The second objective would be to take control of Karg Island. Karg Island is in the Persian Gulf. It belongs to Iran, and it's an island where Iran distributes all of their oil. So they have all these pipelines that go into eventually Karg Island, and ships pull up at this island and get filled up with oil, and then they move through the Persian Gulf, through the Strait of Hormuz, and then they go to other countries. So if you capture that island, Karg Island, then you would control all of Iran's oil distribution. So that would be a very obvious target. And do I think the US could do that? Yes. I think the US military operation in the region could take over Karg Island. We do know that Iran has fortified Karg Island in the last few days in preparation for some sort of military action. I just don't think that that fortification would be enough. So I would assume that the US would take control of Kharg Island and then control Iran's oil distribution. And then I assume that their thinking is to use that as leverage to get Iran to open the Strait of Hormuz. We don't think that if the US has a ground operation, that they would go into Tehran. We think they would avoid that. That gets messy, and now you enter a long-term protracted war. So that's not our thinking. Our thinking is Kharg Island and the Strait of Hormuz. So who knows? You got to watch the developments within the coming days, coming week. I think the thing will either settle down or escalate fairly quickly. We'll know what that solution is, partly because it's just cost you a fortune to keep 6,000 troops within that region. You can't just do that indefinitely. So we'll know the outcome of that. But at this stage, these sorts of numbers are using an assumption that the war ends within the next few weeks. We remain optimistic. Then just lastly on this war, there's a bizarre positive outcome of the war for the US, and that is when you blow up small countries, you boost your economy. How much do you boost? So if you go back to the war in Iraq, the US economy prospered by 0.4% in terms of GDP. So to put that in context, you're growing your economy, let's say at 2%, you blow up Iraq, you're growing at 2.4%. That's what it means. Similar when you blew up Afghanistan. And there's no doubt that the latest action in Iran will reveal itself in terms of a positive boost to GDP. It's not the most efficient use of resources. It is highly inefficient, but it has that spin-off effect, which is quite bizarre, but it's one of the consequences. The US generally, though, people say, oh, the US is going to war because they want to boost their economy. I think that's always false. I don't think the US does that, but it is a byproduct, given that the US manufactures most of their military equipment. The US Army has asked for 200 billion more in military budget. At the moment, they spend in a year just short of 1 trillion. So if you said, what is the US military spend? It is approaching $1 trillion a year, and they've asked for 200 billion more. And there's no army in the world that spends anything close to that, not even remotely close to that. It's just a phenomenal number. All right, so let's turn our attention to South Africa. The South African growth remains the problem. The story remains the same. The story is, how do we get the growth rate stronger? On the screen, I put up a chart of the government's latest GDP forecast. This came out in the February budget. And what it says is that in 3 years' time, the government believes the South African economy will grow at 2%. Now, obviously, 2% is better than 1%, but 2% is hopelessly too low because the population grows rapidly in South Africa, 1.4%. We need to add 600,000 jobs a year. 2% won't do it. And so we really need to get this growth rate above 3%. And ideally, we need to get it up at 4% and then keep it there. And obviously, that's the task. Can we achieve that? Is it achievable? Yes. Could we get it right? Yes. Have we done things? Have we put things in place to achieve that? Yes. Do I think it's possible to get there? Yes. Do I think we're going to get there within the next year or two? No, it's going to take longer than that. But I do think we're making progress in the right direction. So 2% is better than we were, but it's nowhere near enough. We need to get way more ambitious than that. And it worries me that government, with all of their knowledge about some of these developments, still is only got growth sitting below 2%. So where do we get the growth that we do have? What do we do that gives us some growth? We go shopping. The shopping in the last year has been spectacular. So we've done really well. Last year, we grew shopping at 3.7%. And if you think the economy grew at 1.1%, so GDP growing at 1%, shopping growing at 3.7%. That's a massive difference. So we really excel at shopping. Where did we get the money from? Well, we got part of the money we got from the two-pot withdrawal. Not a great way to go shopping, but that's what we did. We got some of the money from credit. We got some of the money from salaries because inflation's coming down. That helps us. So a little bit of everything. And we did really well with shopping, right? The problem, as I keep saying, is you can't shop your way to success in South Africa because a huge percentage of this is imported. We import, except for food. Food, we make a lot of it locally. But everything else, there's a tendency to have a very high import content, mainly from China and other countries. And so we don't get the full benefit of this type of shopping. Now, many people should be saying to themselves, geez, shopping at 3.7%, how did we afford that? And the way to understand that is to look at our savings level. So what percentage of our disposable income are we saving in South Africa? And I want to show you that number. And that number's gone negative. Actually, quite a lot negative. So what does that mean? How does the number go negative? It can only go negative if you spend more than you earn, which means you're living beyond your means. Now, that happens in every society for a segment of the population. Young people they want stuff, their income is not great, they're using their credit card, and they shop more than they earn, and then they end up with some debt, and some people go too far and get into trouble, or all of that happens in every economy. The problem with this number is this represents the entire country. This is not, a small section of the population is living beyond their means. This is the entire consumer base is living beyond its means, which takes some doing. This is impressive shopping, but in the background, it's suggesting we're getting ourselves into financial difficulty. So it's not sustainable. We can't just keep doing this, right? As much as it sounds wonderful to keep shopping at a growth rate of 3.7%, we can't do it unless we create jobs, unless we create other forms of income. So it was good for us last year. It helped us, but we can't keep doing it. So what is it that we should be doing that we're not doing? I want to show you a couple of things. The first is we should be doing mining exploration, and we're not. In the last 10 years, mining exploration has declined by 56%. That's terrible. So you can't really expand your mining sector unless you are looking for more mining deposits. And this number has dwindled over time. So there's very, very little new developments within the mining industry. There's no new mines being built. There's very little expansion of existing mines. Not a great outcome. On top of that, look at the construction sector. The construction sector in South Africa has had 9 consecutive years of recession. That's massive. The industry has declined for 9 years. The total decline is 35%. So yes, the economy is growing at 1% because we're shopping. But what we're not doing is we're not building. And when you build something, every time you build something, you're building for the future. Think about it. You build a road for the future. You build a hospital for the future. And so what it ends up telling us is we're consuming for today, but we're not building for tomorrow. And that mix is terrible if you want to be prosperous. If you want to just have a good time, fine. But if you want to be prosperous in the future, you have to build for the future. And we're just not doing that. And yes, government keeps talking about all of these investment plans, but a lot of that is just talk. The question is, are you translating that into real activity? And this chart would tell you no, and it needs to change. If you want South Africa to be successful, this number has to be not just positive, it's got to be significantly positive. Look at housing plans passed. So this is where people submit plans and want to build a house or expand a house. So this would include house alterations. This is at the lowest level in decades. And we've got a massive housing shortage. So these are the types of numbers that should be a lot stronger. Construction, building, mining exploration, all of that speaks to fixed investment. And in order for South Africa to be prosperous, that element of the economy needs to turn around considerably. So what is it that we need to achieve? Well, if you look at first look at the blue line, that's the developed world. They spend just over 20% every year. They spend over 20% of their national income on building for the future, on investment. Investment is always for the future. So that's not massive, but it's a meaningful portion of their economy. So what does the developed world spend this money on? If you go to Belgium, I've just picked Belgium at the moment. You go to Belgium, they've got all the roads they need. They've got the railway system they need. They've got the hospitals they need. Their population doesn't grow. So what are they spending 20% of their money doing? They spend that money maintaining the infrastructure, maintenance. They spend the money on, if there's new technology, they upgrade the systems. So they make sure that the system they've got in place functions every year appropriately. And in order to do that, they've got to spend 20% of their national income making sure that happens. The purple line is the emerging market world. South Africa is an emerging market, and they spend at the moment over 30% of their money building stuff. And why do they spend more? Because they don't have stuff, right? They need more roads, more hospitals, more schools, more of everything. And so emerging markets have to spend more because they've got to maintain what they've got and then build more stuff. And so emerging markets, if you said to me, because they spending all of this money building, how fast do their economies grow? This year we're looking at 4.2% growth, average. That's the average for emerging markets. Eh? That's not the best. That's just the average, 4.2%. Developed markets grow typically at 2.5%. They grow less because they're not investing as much. Where's South Africa? If we put South Africa on this chart, where do we end up? We've dropped below 15%. So what's wrong with 15%? Well, when you're at 15%, you're not spending enough to maintain what you've got. That's the problem. And so year by year, if you don't spend the 20%, things decay, things break. That's why if you go out in South Africa and you look around, you'll see, oh, the water's broken, the potholes have increased, the road repair is not good, the railway system's not working, electricity is a problem. All of these things are problems for one simple reason. You're not spending enough to maintain what you've got, let alone build more capacity. And South Africa desperately needs more capacity. So if you say, well, no, South Africa, we've got to grow this economy at 4%. How do we do it? Very simple. Go build stuff. Don't go shopping. I'm not saying don't shop. We have to shop. Please keep shopping. But it's not about we need more shopping. No, keep shopping, but then build more stuff. And it's the building the stuff that makes the key difference to every economy. And so if you said to me, if we take this fixed investment from 15% to 20%, what happens? South Africa will grow at over 4% GDP. How do I know that? Well, I know that because if you go back to 2006, 2007, 2008, we got the fixed investment over 20%. In those 3 years, each year, South Africa grew the economy by more than 5%. We added 500,000 jobs or more than 500,000 jobs a year by doing that. So we've done this in the recent past. Obviously, at the time, we were building for the Soccer World Cup. That doesn't mean we need another Soccer World Cup. But what it tells us is that you've got to go build stuff, just not stadiums. So build stuff that we need. Build a railway, build more power stations, build water plants, build the stuff and the economy will grow. You'll add jobs. And then those people who've got new jobs, they can increase shopping. And then everybody benefits, right? So that's what we've got to do. Now, government's aware of this, finally. They worked it out. The problem for government is they don't have the money, right? So you say to government, build this stuff, and we don't have money because we've got too much debt and we're trying to be disciplined, etc. So we've got to then realize, oh, we've got to partner with the private sector. And so that's why we keep talking about the private sector partnership, because it's the only solution that's possible. Fortunately, the positive is that there's now good developments. Look at energy. It's now up at 17,000 megawatts, private sector renewable energy projects. A power station is 6,000 megawatts, typically in South Africa. This is 3 big power stations we've put in place, driven by the corporate sector. Last year alone, 600 companies initiated renewable energy projects. And if I look at the NERSA website, more companies are adding projects every month. This isn't stopped. So don't think of this, oh, we built it and that's the end. No, more companies are adding more solar plants. And how did this happen? It's happened because government deregulated, government changed the rules, government said we will allow the private sector to invest in the energy space, and the private sector said, thank you very much. Now the government is working on expanding the transmission lines. You're going to see that being announced this year. And we're going to be using the private sector to build more transmission capacity. It's going to cost a fortune, but there's a realization we've got to do that. And so private sector is going to be appointed to develop the transmission capacity. Please watch for that later this year. We've also got good initiatives in rail. Look at what happened to our rail. We got to look at the chart, 220 million tons of goods being transported on our rail, and then that collapsed to 140 million tons. Government saying, no, you can't do that because all of those goods went onto a truck, which went onto the road, which has destroyed the roads. So how do we rectify the rail system? Well, we appointed private sector operators. The government has appointed 11 operators. They tell us 7 of them will be functional in the first quarter next year. On top of that, a company called Traction, which is a private sector South African company, they're the biggest rail operator in Africa. They spent 3.4 billion buying 46 locomotives and 920 wagons from New Zealand. Why New Zealand? Because those locomotives fit South Africa, and those things will arrive in June and July this year. That deal is done. That's not, oh, we maybe possibly will be doing this deal. The way we maybe possibly will be spending, building high-speed rail. No, this deal's done. The locomotives are going to arrive in June and July. They're going to get spray painted, and then they'll be used by the private sector to help re-energize the rail system. So that's a very positive development, and I'm expecting more will be added to this as we go into next year and beyond. And then the third key development is we finally signed the contract with the Philippines company. It's been years. This has taken 3 years, but the Philippines company signed a deal, a 25-year contract to run Pier 2 Harbor, which is the container port within Durban Harbor. It's the biggest container port in South Africa. It's critical to our imports and the efficiency of distribution of goods. The Philippines company runs 34 ports around the world, and they signed a 25-year contract. They own 49% of Pier 2. Government owns 51%. They're going to invest a huge amount in upgrading the port capacity. And I've got no doubt that in time, this will add to the efficiency of Durban Harbor. And what Barbara Creasy as the Minister of Transport has said is, if this works, we're going to do it for other ports. So these developments are critical for us, right? Because they are clear examples of government realizing we need to invest, we need to build stuff, we need infrastructure, we don't have the money, we have to partner with the private sector. And that process is underway with many more projects in the background. I only want to focus on things that have actually been announced that are happening. But if I listen to the meetings I'm in, there's lots that's been worked on. So I'm optimistic in a year's time, there'll be more stuff being added. So all of that's good. Where's the negative? The negative is the damn oil price. So let me show you what our problem right now is. Our problem now is a petrol price that is likely to go up 6 rand, 6.50 a litre. That's a monster increase. That excludes the fuel levy. I'm hoping the government will decide to postpone the fuel levy hike. They can't do it indefinitely, maybe about 2-3 months. But we're looking at 6 rand, 6.50 a litre. That's a monster increase, right? And then that's the good news. The bad news is the diesel price. We're looking at an 11 rand increase in the diesel price. That's huge. And obviously, as that increase comes through, it's going to hit consumers, it's going to hit business, and then we're going to be worried about, okay, so what does that mean for inflation? The petrol price going up means inflation goes up. So we're going to take inflation from 3% to over 4.5% in 1 month. The target's 3%. We're patting ourselves on the back. We've achieved the target. It's going to go over 4.5%. And then the longer the war continues, the more this becomes problematic, because it's not just a short-term shock. It can become an embedded shock, which then adds to our woes. So, geez, this is coming along at exactly the wrong time for South Africa. So let me show you the implications of this for inflation. And again, I'm using an assumption that the war ends within the next few weeks. So let's look at what the inflation forecast was before the war started. This is what we were looking at. And remember, we've got a target of 3%. This is a beautiful chart. The inflation rate came down to 3%. And look at the forecast. The forecast said we're able to keep this under control. So what did that mean? It meant we expected the Reserve Bank to cut interest rates twice this year, and we expected them to cut the interest rate twice next year. That's 100 basis points down. That's a full 1% expectation of interest rate cuts, because we're pretty much achieving the new inflation target. That is what we were looking at. And then the war happened outside of our control. And because the wars happened, now we're looking at this as our scenario. And this is the best news. This is the good news scenario. So what happens if the war becomes extended? What happens is the numbers go up, as I've got in the chart, and then they just struggle to come down. And what does that mean? You now start to talk about interest rate hikes. I don't think it happens in the short term. The Reserve Bank will adopt a wait-and-see approach, rightfully so. They'll say, this is a shock. We were going to cut rates, but we can't. This is a shock. We need to put interest rates on hold, and we need to watch how things develop. But clearly, if it becomes worse and worse and the oil price stays high, then they're going to worry about what that means for broader inflation, and they'll put up interest rates. And people will say things like, but how can they put up interest rates? That's not going to bring down the oil price. That's not going to bring down the petrol price. And it won't. It won't. It's not designed to do that. But the Reserve Bank has to worry that if the oil price and the petrol price goes up, then a whole range of other prices will go up. And they will worry that consumers will use their credit cards to fill up their tank and keep buying the same amount. And that will just fuel more inflation. And they want to achieve their 3% inflation target. And so the longer this carries on, the more they'll be forced to consider hiking rates. So unfortunately, we are in a good space, I must say. The developments, let's ignore the Iran war. Geez, we were moving into a much better space. Government finance being managed well, inflation under control, looking for interest rate cuts, looking for another credit rating upgrade later this year. All of that, good news. Clear evidence of private-public partnerships, good news. We were starting to get foreign money into South Africa. Excellent. Now we have to deal with this shock. I'm hoping the shock is short-lived so we can get back to our better journey. But we've got to be realistic. If this thing turns worse and the war is extended and the oil price stays where it is or goes higher, then it's going to cause more damage. I know that's bad news, but that's our reality. That's all I'm going to ramble on about. I'm worried about time. I don't want to take Rico's time. I don't know if there are any questions, Corday, if anybody wants to ask anything.
Yeah, Kevin, for now, there's no questions in the chat, but yeah, thanks for putting us in the loop and how things are playing out and the updates. So certainly there is positive things in South Africa. I mean,
Yes.
clearly we can see that pri the private public sector is um, not public, the private sector is contributing to a meaningful way, and things are
Yeah.
happening. I mean, we've been waiting for this for literally decades.
Yeah.
So that's good news. It's just unfortunate where we are at this point in time. So naturally, this Middle East conflict is a curveball, I think, for the rest of the world, and I guess we need to wait and see how this is going to play out. I do think the positive thing that we do have is that we do have an extremely conservative SARB. And Letsetja Kganyago, I think, is doing a sterling job on trying to keep a lid on things and not let his emotions and whatever's happening in the world run away from us. So I think that might probably help a little bit.
Yeah.
And the independence of the SARB, there's no issues there that we need to worry about there.
No, no. Lesetja is highly independent and cherishes that. He'll fight for that independence. And I think the Minister of Finance fully understands that and accepts that. There will be questions when when the petrol price goes up for government to provide assistance. There are not many options. The reason is, I mean, they can delay the fuel levy a couple of months, but beyond that, it just becomes too expensive. These numbers are enormous when you start to say, government is going to subsidize the petrol price, or government must get rid of the fuel levy tax. That sounds great, but it generates a lot of revenue for the government. And if you do that, now you go from fiscal discipline and a credit rating upgrade into, ooh, now you've got even more debt, and now you're not going to get the credit rating, and you're undoing a lot of the positive you put in place. And I just don't think the government's going to want to do that. So unfortunately, there's not a lot that we can do about this oil price shock. I'd love to tell you we can do this. But, everything. If we try and do something, there's a cost, and that's a political decision. But I think at this stage, I think we just got to work on the assumption that these are the price effects we're going to end up with.
Yeah, so Kevin, I must say it is a bit of a scary thought to think about the fact that if this is going to be not necessarily a prolonged conflict, but I mean, if oil price is going to remain high, what the long-term impact that might have on us as a country. I mean, that is fairly scary at this point in time, and I do think it can have serious ramifications and
Yes.
long-term
So let's
effects on
say
us.
that
So,
this lasts for the let's say it lasts for the remainder of the year, where you've got an oil price above $100 a barrel. Now, instead of saying, "Oh, I'm looking for, 1.6% growth, 1.8," now you're marking growth down closer to 1% or even slightly below that, because the petrol price increase is worse than a tax. If I'm government and I increase your taxes, you're not going to be happy. But the advantage is that government's now got your money, and potentially they could do something with your money which would add to the country, right? But with a petrol price increase, it's effectively, I'm taking your money, giving you the same amount of petrol. You're no better off. You've got the same amount of petrol. I'm taking your money and I'm sending your money overseas to somebody. There's no benefit. So it's worse than a tax. And if you do that for 1 month, the country can absorb it. We're not happy. Do it for 2 months. Okay. You do that for a year. That's a lot of income you've lost. That starts to have a negative effect on your growth rate, which then ends up with the economy slowing rather than what we thought it was going to do is accelerate. That's the problem.
No, I know I'm almost going to finish up here, but yeah, I think the one big thing that people are quick to forget is the fertilizer
Yes,
issue, in the sense that that's also going to increase a lot, and that's going to increase a lot of food inflation.
yes.
And the petrol inflation or diesel is going to just make that a lot worse. But yeah, so it's not looking great if the war is to continue for a long term. I've got one last question for you, Kevin, and that's we've heard again from all the economists out there like yourselves over the past couple of years that what we need to do to fix the country. It's
Yeah.
almost like everyone knows what we must do to fix the country, but just doesn't seem like the government knows it, or is doing it. Do you, as an economist, and all the rest of the economists, do you have a forum where you actually get to meet with government and tell them what you are telling us, and show them the numbers, and try to convince them of what to do, and what not to do?
So the answer is yes, we do. But yes, but so so where we meet with government is in three main areas. The one is we meet with the Reserve Bank a lot, but don't that's not government, that's truly independent, but there's a lot of discussion with the Reserve Bank. We meet with National Treasury a lot. We have workshops with them, and we would discuss, and they ask us. In other words, they purposely set up a workshop with private sector economists to say, "Come and tell us what your thinking is, etc." And we would convey all of the same message to them. And at this stage, National Treasury would not disagree. It's not like National Treasury sitting there saying, "No, we don't know what you're talking about. This doesn't make any sense." They would fully agree with those views. And then we discuss a lot with Rudy Dix and his team, which sits in the office of the presidency. So that's Operation Vulindlela, and they are tasked with a lot of these reform initiatives, the private-public partnership reforms and other reforms. And there's a lot of engagements. And we would, for example, invite Rudy Dix to come and talk to us in our investment meetings, and we can have a debate with him and tell him our views, and he's very receptive to all of that. So that discussion happens. What doesn't happen is we don't meet with the Department of Education. We don't meet with the Department of Healthcare. We don't meet with every government department. We meet with those three entities, and we know that government is much broader than those three entities. And so it does feel to us that we're talking to people who already know this and are in agreement with this, but they themselves have a high level of frustration in trying to get this all implemented. So if you meet with National Treasury, you will hear a huge amount of frustration from National Treasury that they themselves are struggling to implement the correct measures within government departments to make sure government doesn't waste money, to make sure government spends the money on infrastructure, to make sure that municipality. An example would be, right, silly example, but listen to Enoch, the Minister of Finance, talking about Johannesburg after the budget, at the budget breakfast. You go to the budget breakfast and you're talking to Enoch about Johannesburg, and you're thinking, what is he saying? He is scathing of Johannesburg, telling us that National Treasury is going to have to get involved day to day in the way in which Johannesburg is managed. That is him being very critical of the biggest city in South Africa being mismanaged. That's frustration from within Treasury. So when you say talk to government, yeah, but it doesn't mean that all of that permeates into an improvement, because the people we talk to kind of already know this, buy into it, and they want similar things implemented. The bureaucracy is extreme. It takes a long time to make this stuff happen.
Yeah, so I totally agree with that. It's so difficult, but I think the elephant in the room, and it's a question from the audience, is basically where's all the money? So why do we not mention that money to maintain and build is being stolen? And that is the biggest threat to any form of growth and a
Yes.
sustainable economy.
Yeah, so you're right, 100%. So it's worse than the numbers I'm suggesting, because remember what I'm doing is showing you how much is being allocated. Now, that doesn't talk to the efficiency of spending. There's a big difference between I spend X amount repairing a road, but how well did I repair the road? The numbers can't tell you that. And we know that a lot of road repairs are quickly, the road is back in the terrible condition and so on. So, yeah, 100%. It's not just about spending the money, it's about spending the money wisely.
Cool.
And so the last workshop I had with National Treasury was about exactly that topic. The topic was it's one thing to control the spending, discipline, but it's a whole different ball game to make sure that what money is spent appropriately, is spent efficiently. And that is even more frustrating. So yeah, I agree with you.
Cool.
It's an uphill battle.
Thanks so much, Kevin, for your time and for
Sure.
giving us all the information. It's really appreciated. Appreciated from all of us. And yeah, good luck for the rest of your day. Thanks so much.
Thanks, Connie. Thanks, guys.
Yeah, and so now we're going to move over to Rico. So as you know, we at Morebo, we are making use of the expertise of a discretionary fund manager, and we are making use of the services of STANLIB Multi-Manager and Innate Invest. They build and assist us to build our portfolios and to help our clients with their investments. So I just want to do a quick introduction of Rico and explain to you what he's been doing for us. Rico started his career in 2004 at Life Healthcare as a credit analyst. In 2005, he got an opportunity to work for the FSCA as an analyst in the Collective Investment Schemes Department, where his passion for unitized investments started. Rico subsequently joined STANLIB in 2007 and served in multiple roles, including heading up the STANLIB Asset Management Implementation Team. In 2013, Rico joined Innate Invest and STANLIB Multi-Manager as a research analyst, conducting investment research and building investment management tools for the business. Since 2016, Rico has been a member of the portfolio management team and managing various multi-managed funds and models. Currently, Rico is the head of portfolio management and Innate and STANLIB Multi-Manager. Rico, um, thank you so much for taking time to speak to us today. Yeah, can you perhaps maybe just give us an overview of what you do as a DFM, what your role is, and what you fulfill, and how you have structured and managed the Morebo portfolios in these challenging times like we're seeing today? Thanks.
Yeah, definitely. And thanks for the introduction, Cornay. So Kevin's slides and his presentation was a fantastic background just to lead into my presentation today, Cornay. But before I go into too much detail, I think as South African investors, it's quite a challenging period for us at the moment. We've had fantastic returns last year from the local equity market, to a large extent driven by performance in gold and platinum shares. But as Kevin alluded to, it's not all good in South Africa. There are lots of challenges one needs to consider. And through this presentation, I will reference back to this challenge being a South African investor, but also the opportunities in South Africa, and also talk about diversification as a key concept that's very important. Now, just to give you a brief overview for those of you that are not as familiar with us, we're one of the largest DFMs or multi-managers in South Africa. We've been around for over 2 decades. This is the investment team that looks after your funds on a daily basis. Quite a few local team members, as well as team members like Kent, Dave, and Carl, sitting in the UK and on the Jersey Islands. So comprehensive teams, strong team covering various areas of investments. Now, before you get scared, I'm not going to suck up time today talking about process and philosophy too much. But I think the key thing to remember is really point 1, 2, and 3 on this process slide. For us, when we construct portfolios and working with Morebo over the years, the most important thing when you start out with a portfolio is defining the objectives of one's portfolio. Now, for the Morebo solutions, there are two clear objectives. Firstly, in the longer term, we want to be competitive versus industry peers. Else Corneille and Ashley and the advisors will really struggle to be competitive versus their competitors. The other thing that's very important for us, and that's probably the most important for clients, is long-term wealth creation. And how do you do that? Well, it's a simple answer, but it's quite difficult to do. Is you have to beat inflation consistently in the medium to long term by a specific margin, and that margin depends on the type of risk profile a client selects. Now, depending on the risk profile, if you happen to be in the solution where we target CPI plus 5, which is typically a high equity balance solution with close to 70 to 75% equity, that does come with volatility. The market pays you over time that real return of 5%, or the assets that we buy pay you that real return because you're taking on the risk. It's that risk that provides that opportunity. Now, the second thing after defining the client objective is also figuring out what is the right asset allocation. I said the market or the assets in the market pay you that real return in the long term, but how do you know which are the assets that pay you the higher real returns depending on your risk profile? So that's where we do a lot of work. And then lastly, I'll touch on the manager research and portfolio construction briefly. Now, asset allocation, you don't have to really understand the slide. I'm more than happy to take any one of you through it in more detail, and Corneille is very familiar with it, and the rest of the Morebo Investment Oversight Committee. But we do an optimization exercise every year. We use over 100 years of data. It's in fact 125 years of historical data on asset class returns. We use forward or expected asset class return assumptions, and we push all this data into a very sophisticated optimizer that then generates the ideal, or we call it the optimal asset allocation to achieve different expected returns. So going back to my example of trying to achieve CPI plus 5 or aiming for CPI plus 5 over the long term, you can clearly see, if you can see my mouse here, to achieve those returns, those high returns, and these are gross of fees in the axis down there. So one has to deduct all the costs associated with investing, but roughly to achieve a real return of CPI plus 5, one needs sizable equity allocations, and that's around 70% in equity. And then the optimizer suggests you need a bit of bonds, and you need a bit of SA bonds, SA cash, a bit of property helps in that diversification, etc. Now, again, not really that important for you to understand the detail, but this is really to illustrate that you need to take on risk in the long term to achieve your objectives. As soon as you start getting too much of this blue stuff, which is SA money market, as soon as you sit too much in cash and income type assets, in the long term, your real return expectation drops materially, and it starts, if you're fully in money market only, over time, after fees, it's highly unlikely to achieve any meaningful full real returns. Now, this is an important step for us. We call it our true north. We don't necessarily go to asset managers or invest directly into these proportions, but we know over time, this is broadly our roadmap to achieve the long-term success. Now that we've defined the objectives, which we do for every portfolio, and we constantly review it, we know more or less for every type of risk profile what's roughly the best asset allocation in the long term, and the next step is to find the right asset managers to then put in a portfolio to blend into a solution to match roughly the asset allocation we need to achieve. Now, this is where we spend most of our time. Our research team did some analytics last year. If I recall correctly, 5,000 hours was spent on manager research, sitting in due diligences with these managers, report backs, asking them what their latest views are, understanding their processes, philosophies, etc. And this isn't a comprehensive list, but what I've got on the screen here is some of the key managers we use. So we've partnered with the likes of Coronation. We use their balance and defensive balance funds, their income fund. The biggest asset manager in South Africa, 91. They're one of the managers we use extensively across the solutions. ABAX, a manager more recently included in the multi-asset portfolios. We've got 361, exciting boutique. Lorium, another boutique. Truffle, another boutique. So as you can see, we've got a few of these big asset managers. We like to call them the cruise lines or the big ships. They're slow, they don't turn quickly, but they're steady and they get you there. They form the core of the solutions. And then we've got these speedboats, the 361s, the Loriums, many of these boutiques. They're fast, they can rotate in and out of shares, especially bigger shares. That's often difficult to sell in the market. And they can create that extra dynamic. And that to us is a perfect intersect of diversification amongst managers. You can also see some of the offshore managers, Sands Capital, Sanders Capital, some of them based in the US, some of them based in the UK. And through the solutions we've constructed for Morebo, you get access to these offshore managers, what we think are some of the best asset managers in the world. JP Morgan, another big one there, that you get exposure to and that we've partnered with to using those solutions. I'm going to show you one last quant slide. So once we've selected this database or library of managers that we use, we have to figure out what's the right combination. There's no point for us to go and buy two managers that do exactly the same thing because clients won't get the diversification. So we use various statistical techniques and tools. And I'm just showing one of the many techniques. One of my favorite ones is the dendrogram, where we test these managers and test their relationships to each other, how they correlate and behave relative to each other. And one could see some of the managers in the industry and some of the ones we use, like ABAX Balance, they sit quite close to a manager like Kermisa. They used to be called Kagiso Kermisa. Allan Gray Balance, you can see they're quite close to a manager like Denker and Melville Douglas. And this just gives us a good sense of picking managers that diversify, that stop rated according to our list, and that tick the box of having the right asset allocation to fit into our construct. So what's the end result? So the end result, and I'm using one example here, the Morebo long-term capital growth portfolio. This is a typical high equity balance fund. And you can see the array of managers we've got in this solution that we've designed in conjunction with the Morebo IOC. And you'll recognize those names. Many of them I mentioned already. 361s, ABAX, some of the boutiques, Allan Gray, Coronation, some of the larger managers. Well diversified across these managers. You can see some of our offshore, etc. But very happy to take some questions on this as well. Kunai, please interrupt me as we go along if you've got any questions. Now, performance, the stuff that really matters, obviously. And before I show you the performance of the range, I thought it was important to just provide context for last year. As at the end of February, over the last 12 months, SA equity delivered a staggering 55% or just under 55% return. That's been a phenomenal return from the local equity market. It's in stark contrast to our experience on the local equity market just before the elections in 2024. And it was mainly driven by gold and platinum shares. Obviously, with tensions in the Middle East, subsequent concerns around Trump's presidency and whether the US dollar will continue its trend. really a lot of concerns started there, and the gold price started rallying all the way to $5,500 in early in the year. And that's what's pushed this gold price so high. However, many of our clients ask, but why did our funds not return the 50% that the local equity markets return? But the important thing is we don't create SA equity portfolios. Yes, we've got it, we can create, but we are guided by Regulation 28 and various regulatory requirements, as well as the CPI plus mandates that we agreed with Morebo, and we think that's the right thing to do in the long term. You can't put all your eggs in one basket in the local equity market. I mean, I want to use a scenario. Last year, Liberation Day with Donald Trump. Who would have thought, after all the tariffs Trump implemented, that the local equity market would rally so hard? In fact, there were talks of sanctions against South Africa at that point in time. Imagine, and I believe it wasn't too far, it wasn't too far off, but imagine sanctions being implemented in South Africa. You would have seen a minus 50% return or minus 30% return from the local equity market. So we try to be highly diversified in the solutions to beat those real return objectives over time. Last year wasn't a great year for global markets, and to a large extent, it was because of the appreciation of the rand. Global cash and bonds delivered negative returns, and global equities barely squeezed out a positive return after accounting for rand appreciation. So once we put this multi-asset package together, how did the solutions perform? Now, firstly, I mentioned we compare ourselves versus industry peers, and we've got a long successful track record of beating equivalent peer group averages. And over time, we've done that for the solution. Unfortunately, last year, we left a little bit of performance on the table relative to industry peers, as we were underweight gold and platinum marginally. However, relative to our main objective of creating wealth for clients, we did a fantastic job. As an example, carrying on with my long-term capital growth fund or solution example, the solution delivered about 21% after fees, and over the last 3 years, 13.7%, and since inception of this particular range, about 12% return per annum. Now, if you look across the range, fairly good returns to the income solution. And bear in mind, an income solution's got no equity in there, maybe a tiny bit of prefs here and there. 12.3% return last year from the income solution. So we're very pleased with the outcome of the solutions. The flexible long-term capital growth portfolio, that's predominantly an offshore portfolio. Now, I mentioned earlier, offshore assets virtually gave you zero return. This portfolio with 60 to 65% offshore produced almost 17% return last year, or over the last 12 months rather, after fees. So very happy with performance over the last 12 months. However, as you all know, things changed rapidly in March. Now, we haven't finalized the March numbers, but early indications are that the income solution marginally down, probably less than 1% down in March because of the bonds and hold, and then the multi-asset solutions, the rest of the solutions down probably between 2 and 4%, depending on the risk profile. Now, again, I mentioned South Africa being quite a risky asset class in isolation of South African equities. The SA equity market was down 17% at some point during the month. When I looked this morning, it was down around 10%. And there's quite a lot of positive news in the market at the moment that hopefully gets us closer to zero performance for March. So overall, just illustrating the benefits of diversification in a tough month like March, really helping the solutions and not giving us too much of the good performance over the last 3 and almost 5 years. Yes,
Richo, sorry, I just want to jump in there quickly. So the way that you assist us by building these models, what we want to achieve with the models is not ever to be the best performing fund. and also never to be the worst performing fund. What we are aiming to be is always to range in the top quartile of all the managers out there with a lesser volatile experience for the clients. I think that is something that you guys assist us with, and if you can just perhaps touch on those points on how do we achieve that by consistently doing good for our clients and not have that extreme volatile and crazy ride.
Exactly, Kunal. That's exactly it. I mean, it's a fool's game to try and pick the next winner. For us, it's all about picking a range of good asset managers, partnering with them, diversifying them into a solution, and over time get a smoother return. Now, that doesn't mean if markets are down like they are this month that the solutions can't have a negative return in the short term. But what it does mean is we're not just chasing the most recent winners. Yes, we've got some of these recent winners in our solutions, and Truffle is a great example of that. Truffle and M&G have had phenomenal returns, the likes of Laurium 361 as well. But we're not necessarily now just putting more money into or more of the client assets into these outperforming managers because we know markets go through cycles. A manager like 91, their opportunity solution, probably one of the most successful solutions in the long term in South Africa. They've been the worst performing fund or one of the worst performing funds over the last 12 months and the worst performing one in our solution. That said, we're not now exiting 91 just because they underperformed. Last year's environment was just not in their favor because they prefer not to be overexposed to the volatile gold type shares. And I've spoken, and I'm going to chat a bit more about gold, Corday. But when I say asset managers are invested in gold, they're not necessarily invested in physical gold. They're invested in gold companies that's leveraged to the gold price. So if the gold price goes up 50%, these gold companies can go up 100 to 150%. If the gold price drops by 20 or 30%, and we've started seeing that already in March, these companies can be down 20, 30, 50, 70% very quickly. It's not unheard of in the gold sector. And that's why we don't chase the recent winners, because the recent winners were just the managers that were overweight gold. Now, there's an interesting, and sorry, I'm giving a lot of insights on this point because it's such a good question, Cornel. There's an interesting piece of research I've done, and my colleagues and our chief investment officer in the past have done similar pieces of research. But we found that, in fact, if you pick the winners of the last 3 years, so the best performing managers in a certain sector or with a certain objective over the last 3 years, the chances are that they are, or the probability is higher than 50% that they are the underperformers over the next 3 years. Now, we don't invest like that necessarily, but just to give you an illustration that picking the winners over the last 3 years or the best performers is more often than not the recipe for disaster over the next 3 years. But yeah, through this combination, Cornay, we definitely think long and hard about downside protection. The underlying managers do a lot of work. They think about the markets all the time. It's not just us. You've got this, just to jump back, you've got this entire list of managers just in one of the solutions. Top minds in South Africa and globally. A lot of the offshore assets sits in that global flexible fund. Just all day long, just thinking about how to get the best return and how to minimize losses for clients in the market. I'm not going to touch too much on attribution, but good, strong performance for us last year with the likes of Visio and Granite. On the income side, I mentioned Truffle. Truffle is an example, bought European defense shares last year as tensions in the Middle East started escalating. They bought those defense shares that did exceptionally well for us. The likes of Lorium were quite heavy in South African assets. Absa, and a few of those that performed well, and Fairtree, one of the managers that were quite high in resources that did well for us. That's on the portfolio, and we can definitely circle back on later for questions. But I wanted to just touch on our outlook. Now, I mentioned gold, a bit of a conundrum at the moment for South African investors. If we look at the local market, the JSE, about 28% of the JSE is now gold and platinum shares. So that's massive concentration risk. Basic materials is more than a third of the local equity market's return. Now, in this environment, and starting the year, and it ties up with your question, Cornay, how do we manage volatility in the solutions? Now, the general theme from the asset managers we hold in the solutions is that we have to trim gold and platinum shares further. It's rallied really hard. And in the first quarter of this year, mainly in January and February, the managers started pulling back on gold and platinum. And that benefited us tremendously in March. Gold and platinum has also started becoming a bit of a risk-on type of trade, not necessarily a defensive trade. So that's the one thing the managers did. We maintained a sizable offshore allocation, and I'll touch on the reasons for that. But that's the other active decision we make, is to maintain sizable offshore. And as the rand appreciated in the first part of the year, we ensured that we kept on topping up our offshore exposure. And I can't wait for I know the March returns will be challenging for investors, but I can't wait to see the numbers, just to see the protection in action. And I mean, it's just creating phenomenal opportunities for the quarters to come for us. Now, Kevin touched a lot on oil. I'm not going to speak too much about oil, but that's the other challenge in the solution at the moment. And as Kevin explained, the biggest impact is really on inflation and GDP. Now, Kevin touched on a few points. We've been working on scenarios with our colleagues at Standard Bank, and very similar findings. Depending on how long this current environment lasts, we can see inflation easily go up by up to 3% per annum from the current 3.5%. So don't expect inflation to be contained. South Africa is still a very open economy affected by currency and oil prices. At the same time, growth, Kevin mentioned, 1% growth is really on the cards if the war in Iran continues or is extended. And that is quite a challenge for us. However, despite these negatives, one big positive for us remains AI. We are, and Cornay, you can attest to that. Every meeting over the last 5 years, we've got a slide or two on AI. AI just remains a phenomenal positive tailwind for investors. I mean, there's a few examples I show you on the right-hand side. A company like Bank of America, we know banks really well as South African investors. We've got our big banks here, and it's world-class. But internationally, Bank of America solves 98% of customer queries via email, via call centers, etc., through AI without any human interaction. Amazon, we obviously most of us probably take a lot more in South Africa for our own online shopping, but Amazon is growing quite fast here. 75% of Amazon's deliveries are now assisted by robots that's driven by AI. So these are a few examples. I mean, coding, 30% of code is now AI generated globally. And for Anthropic, it is more than 70%. So just massive amount of code being generated. And in terms of adoption, last year, especially in 2024 and 2025, there were a lot of questions from investors. Is AI a bubble? Is it just something that's going to blow over? And I think this year everyone is realizing it's definitely here to stay. Now, if you just look at adoptions, a company like ChatGPT, just after 2 years, they've already got 800 million active users. And now we've got Claude and various other tools growing very quickly, or AI models growing very quickly. Another interesting slide on adoption. Overall, according to an NVIDIA survey that was done the last 3 months, 64% of companies globally now use AI, and 28% of the companies that don't use it are assessing how they can use it. And one thinks about financial services and tech companies, but healthcare is actually the biggest user of AI, with 70% of global healthcare companies, which includes pharmaceuticals, using AI, and that's through research, robotics, etc. Telecoms use it, retail, manufacturing there at the bottom lags, but I mean, one can just imagine how quickly they will catch up. And the big question that comes up is, you know, how do we ensure that we don't fall behind? And I think every single person on this call that's still in the job market and um, potentially even have got kids or grandkids that's entering the job market, you really have to think long and hard about this. And how do we as companies and individuals make sure we don't fall behind this trend? And um, the topic today is not to tell you necessarily how we do it or how we think is going to evolve. But in our company, we do a huge amount of work. We get AI to help us with our commentaries. I think, Kunal, you and Sean and maybe Tancred over the years have seen some of the commentaries we've done with AI, and we're expanding that and just increasingly using tools to help us make better investment decisions, get investment professionals to spend less time on admin and more time on using the brain power to make advanced decisions. So that's really what we are doing. Two or so slides left, Corday. When I saw this slide, I thought I called the slide "Global Dynamics" in one slide. It shows you the global GDP adjusted for purchasing power parity, which is just adjust for the local cost in countries. And this gives you a good sense of growth in the world. And based on this measure, China is already the biggest economy. On nominal GDP, the US remains the biggest. So that already explains a lot of the trade wars we've seen the last number of years. The blockage of US, where the US is blocking chips going into China for their AI developments. So it explains a lot that's going on in the world. But what I want to use this slide for is to illustrate why we are so keen on diversification globally. And if you look at that, and this is not to dismiss South Africa as not being a good investment destination. It's really just illustrating the realities of us being a fairly small emerging market economy. We are only 0.5%, so less than 1% of the global GDP. And that's why we are such strong supporters of global diversification. The benefits are you diversify away from the gold and platinum that I've discussed extensively. You're getting access to AI and technology that you've got very limited exposure uh, for in South Africa. I mean, we've got nice fashion process, and that's about it for technology and AI shares. You get the chance to diversify into the East and the emerging markets where a huge amount of the future growth is going to come from. And you still get exposure to the big tech names if you go internationally. And I mean, don't forget Europe. I use the example of Truffle going into offshore banks and defense shares last year, the likes of Renk and Leonardo, really adding value. That's a benefit of a DFM with good ties to strong local managers and strong international managers is the scope. Yes, in a year like last year, you potentially give up a little bit of upside, but in a month like March and in the long term, and like we've seen over the last 5 or 10 years, it's really the place to be long term. This chart just confirms valuations. South Africa, despite what I've said, and I'm not making a U-turn here on our view on global diversification. Despite what I've said, we still see South Africa as being very cheap at the moment. Yes, some of the resources shares rallied very hard, but the rest of the market is fairly cheap in our opinion, and this is confirmed by various valuation metrics. And that's why we're very comfortable for our managers to retain a sizable exposure to South African equities and to South African bonds that still yield around 9%. Emerging markets in general, the darker red line remains cheap on this forward 12-month forward PE multiple. This is just one valuation technique that's quite strong, but the managers all use different techniques to analyze companies locally and globally. The US definitely the most expensive market, a forward PE multiple of 20. So what that means is for current earning or expected earnings over the next 12 months, if let's just say the US is expected to earn $100 as a market the next 12 months, you're paying 20 times that for that 1 year of earnings. So it takes you 20 years to get your money back effectively, assuming no growth. But obviously, the US has got massive growth, and you're paying for growth, especially expectation in tech and AI companies. So to wrap up my presentation, um, although tragic, what's currently happening globally with the war or multiple wars globally, when we speak to asset managers, and we had Carl Leinberger, the Chief Investment Officer of Coronation in the office on Monday, uh, and he said they're just finding amazing opportunities because of the dislocation in the markets. When you've got a global crisis, a lot of the fundamental laws of investment goes out the window, and that creates active managers that we've got plenty of, especially if they're skilled, massive opportunities to create extra performance and alpha. I mentioned local equities, fairly valued and very cheap once you look beyond the resources. Great opportunities there. Offshore side, the chart and other valuation shows a bit more expensive, but you're getting such a broad diversification and AI exposure, which you can't be without, in our opinion, over the next 5 to 10 years. I think AI is going to, a large extent, drive a lot of returns we get from the market. Offshore fixed interest, our least favorite asset class, but it showed its worth or during the month. We still like to keep some of these assets that are good defensive assets like US government bonds. Just really helps during periods of market drawdowns. And to tie up again to your earlier question, Corneille, so what are we doing? How do we add value? So I like to see ourselves a bit as the conductor of an orchestra. So we've got all these top managers playing their specific music instruments, and they're all brilliant in their own rights. But we need to make them play their music together and create this song uh, for our clients, or this music for our clients. And we think we've got great managers. We've identified one subtle change that will be effective going forward. We're tilting towards what we call adaptable managers. So I mentioned earlier some of the big asset managers with the big ships that move a bit slower. They're great for core and they get you to the destination. But increasingly, we see the value of these flexible boutiques and adaptable managers. Now, in Morebo's solutions, we started increasing exposure to the likes of Truffle, one of our top picks, small exposures to them. We've started trimming some of the bigger asset managers marginally. We made space for the likes of ABAX in the high equity solution. So increasingly, just getting more bang for our buck from these managers. But overall, very happy with the solutions as they are. And looking forward, yes, some tensions in terms of performance and volatility. But once you look through it, we're quite positive. And Corneille, happy in the last few minutes to also discuss that a bit. Thank you.
Cool. Thanks so much for this, Richo. Yeah, hopefully, you guys will be pitch perfect going forward for the rest of the year, and giving our clients very good risk-adjusted returns over these uncertain times. Whilst we're on I just want to refer back to the AI view, how do we get exposure to those AI companies within our portfolios? If you can then just perhaps just run over that. I take it it's in the STANLIB flexible solutions, of the global solutions that we have there, that's included there. I mean, of course, if you can just touch on how do we in our models get exposure to those AI options and AI
Yeah, definitely.
companies out there.
Yeah, correct. So there are a few ways Morebo clients get exposure. So firstly, we've got a direct offshore exposure through the global flexible solution, and there we've got various US and UK based managers. So the likes of JP Morgan is quite big in AI type of companies. We've got other boutiques called Sands, and Sanders, both US based managers, um, extensive exposure to AI through their stock selection. So firstly through the offshore portfolio, and when you say how we get exposure, pretty much every manager in the portfolio is looking at AI as a theme. Um, there's no manager, or let me put it this way, any manager that's not thinking that AI, that you need to consider AI and it is something for the future, they won't even make it into our portfolio, because we automatically think that manager does not think broad enough and has lost touch with reality. So that's the one part. The other one is we invest, various of the managers we invest into, the Coronations, Truffle, uh, Fairtree, etc. Many of those managers also manage a offshore allocation. So we'll go and buy Coronations offshore or the balance fund. They call it the Coronation Balance Plus Fund, and that will have a circa 35 to 40% offshore exposure, predominantly in equities. And within that portfolio, they will make sure that they've got sufficient exposure. And I mean, I used the example of chatting to Carl Leinberger from Coronation in our offices in the week. We actually spent 30 minutes of our 1 hour meeting. No, we actually spent an hour of our 1.5 hour meeting with them because it overran, talking about AI and how Coronation is thinking about AI, how they're bringing it into their manager research reports. Um, how Carl, the CIO, taught them all to listen to a new podcast around AI that just came out on Sunday, and he wanted the entire team to listen to that podcast. So we're having those discussions, making sure everyone is thinking about markets and economies from various angles, and that's how clients get exposure.
No, 100%. Thanks for that. So of course, this is on top of mind for almost all the clients who's on the call. If everything went well for the first 2 months of this year, then everything happened in the Middle East, and then there's some sell-offs, especially in the local markets, and people do tend to get nervous when events like this happen. Now, yes, we did speak on that, and it's maybe just nice for you to just comment on that as well, not in too much detail, but um, is this time around a bit different? Because if you look at 2022, the Ukraine-Russian war that was there, and it's still happening. Predominantly, Europe was in a bit of a pickle where and gas was a big problem, but it was Europe that was affected mostly. This time around, it's a bit different. It's a global thing. It affects oil, it affects gas, and affects fertilizer. Um, so at this time around, do we think it's going to be something similar, or is the message to the clients that this is very similar to what we've seen all the time in the past, where things are not going as one naturally hope and believes it will, but it will rebound, and this creates certain opportunities in the market or mispricing, as you mentioned earlier. Um, if you can just make say 1 or 2 sentences on that, how do you attack that scenario? How would you tell clients what to do, what not to do in these
Mm.
situations?
Yeah, that's a really tough question. There are no certainties in the market, and the investment in the long term is about weighing up probabilities constantly and trying to make good decisions all the time. And you're not going to get all of them right. We often say if you get 55 and 60% of your decisions right, you're one of the top performing managers. So and I can tell you what the underlying managers are doing in the solutions, and I'll tell you our view as well. So the underlying managers, like Coronation, like Truffle, they're seeing opportunities at this point. They haven't in a big way gone and increased their offshore exposure or increased their equity exposure or anything like that. But around the margin, they're rotating into shares that they think will will benefit from the current environment. They are upping equities in certain areas. So they're doing all these changes. So you've got 10 managers or more than 10 managers in your solution, all just doing making decisions around this event. Now, we are very highly confident that over time that will produce the best result. It doesn't mean we're necessarily going to get this current event 100% right, but the last thing you want to do is what many asset managers and many investors did during the COVID period. Equity markets devalued aggressively. A lot of asset managers got out of the market and disinvested from equities. And then when you get the rebound, it's almost impossible to time that rebound. You lost out completely. And we don't know when the rebound's coming, but we think this event will also uh, resolve, whether it's in the next month or the next 3 months or the next 6 months. And at that time, you need to be ready. And our managers haven't gone and sold equities aggressively. We've sticked with the current asset allocation roadmap that we designed, that I showed early on. We've more or less sticked with that roadmap. There's some tweaks. As an example, many of the managers are buying more inflation-linked bonds locally, because what happens is as inflation starts increasing, inflation-linked bonds is one of your most defensive assets. So they've started buying inflation-linked bonds in the solutions. So Cornell answered quite a few things.
Yeah.
Not quite sure if I got to the meat
No,
of what you were looking
that's good
for.
enough for now. Thank you so much. So, Rico, we're just going to wrap up with one or two last questions. And I think you can just deal with it in one. This is uh, one of the attendees asked, so I know it's difficult, but I take it if you can perhaps, if you want to, make a guesstimate on local versus global. So what are the return scenarios for the next 18 months given global conflict, and is SA insulated? And then a second question, which you can just touch on, is, and I take it's with when you make a move or a portfolio switch within, or a switch within the portfolios per se, what is the approximate timeline of a switch to be made in one's portfolio?
Good, maybe we can just chat about that switch question after I've answered. I'm not sure I understood that question fully. But South Africa is in a nice position in that our resources and gold market, although I said it is highly concentrated, and that's a risk. And I mean, we can only have to look at Nokia in Finland years ago to know the risk of being concentrated in a certain sector in an index. But that does act as a strong buffer for us when there are global volatility, because what happens typically is gold and many of, not just gold, but the commodities we hold locally act as that buffer. Something like coal is a big export. We export a lot of coal. So now the rand is weaker because of the tensions globally. Now our export market picks up because we export gold and coal and other commodities. So you've got that natural buffer. Doesn't necessarily insulate us, but it does provide some protection there. But overall, we don't necessarily think that's enough protection. You have to be diversified offshore, because as the rand weakens, your best performing asset classes are typically your offshore asset classes, and the rand weakens during volatile periods. In terms of outlook, connect to your point, I mean, hundreds of the best people in the world can try and predict the outlook, and
Yeah,
maybe one or two get lucky. That's how.
yeah,
But
sure.
I will tell you what we think. We think offshore mark. We think there's a lot of value in South African markets, so that continues doing well over. And 18 months is difficult. Maybe I know it's not what the client asked, but let's maybe stretch it to a 3-year period and assume we've gone through this current rough patch. Um, I'm confident that South Africa's equity markets can deliver on average 10% per year over the next 3 years. We're not going to see a 30% or 40% like we've seen the last year and a bit. But I'm confident we can do 10% per year. What can offshore markets do? Now, offshore developed markets where US tech is still quite expensive, but who knows what these tech companies can do? NVIDIA, every time they produce results, it surprises. The US, the S&P 500, they're busy with earnings season. Earnings growth is 13% per annum over the last 12 months. So I'll be surprised if the US, that in dollars, doesn't match South Africa. So I think that 10% number that many investors got used to over the years, that's a fair number for expectation in the years to come, because we already had this big rally. SA versus global, maybe SA slight marginally outperforms global equities over the next 3 years, just because of that slide that I showed you on the forward PE, where the SA market is still very cheap. The big opportunity, we think, and again, not necessarily 18 months, but longer term, is in emerging markets. I mean, the Chinese and in Asia and in general, um, it's just phenomenal what we're seeing there in terms of technology and the quick growth and catch up in AI. And those markets are cheap. So you've got this big global GDP growth expectation. The East is growing really fast compared to the rest of the world. You've got AI being a kicker for them, and they're catching up. And well, I've got no doubt they'll match the US in the years to come. And you've got the third component that's quite cheap to other developed markets. So I think that's longer term a place to be, the place to be, or the place to be overweight at least.
Well, thanks so much for that, Ashley. So Rico, so I just quickly want to answer a question for Gail. Gail asked, she's got money lying in a tax-free savings account, and how to deal with that and how to invest it. So I would probably suggest, and without having more information, if it is a long-term investment, I would certainly take on the risk for that. So Rico, I want to leave you and thank you for everything. I want you to, if you can, leave us with one last note on our clients for your piece of advice for them for the short term and the long term. Thanks so much, and I will leave you with that for the last comment. Thanks so much for
Yeah.
joining us.
So firstly, Corné and clients, thanks so much for the support. We really appreciate you attending the webinar today. We think it's just we have to see this period through. Fortunately, as I pointed out yesterday, unfortunately there has been some value lost in the short term, but it's not material in nature, and we think it's an excellent opportunity to create long-term wealth. And our managers and us see plenty of opportunities looking forward. So best ways to stay invested. Thank
So
you.
thanks for that, Rico. I mean, overall, I do think the message was fairly positive. Yes, there's small bumps in the road, but I think the message for clients are very simple. Stay invested. Do not make rash decisions. You do have excellent fund managers that is taking care of your investments. They are looking at it on a daily basis, and know that you are well protected, and there is lots of research that goes into selecting the fund managers. And if you have the time horizon that is in your portfolio, you will and should ultimately reach that goal. So yeah, thanks so much. I'm going to leave it there. Thanks so much for attending us today. Thanks, Rico. And thanks on all the guests. Have a wonderful day and enjoy the rest of the week. Thanks so much.